Bank stocks have fallen following some large bank failures, starting with Silicon Valley Bank. Now, whenever stock prices fall, this creates opportunities. So in this video, we'll look at where that sell-off now puts us in terms of valuation for US financials relative to the broader US market. We'll also consider some reasons for and against buying banking and financial stocks right now. Now, if you do enjoy our content, please do subscribe to our channel. That way you won't miss any new videos. So let's look at the bank crisis investment opportunities right now in a bit more detail. Let's begin by looking at the size of the sell-off. Beside me here you can see a selection of ETFs which give you exposure to banking and financial stocks. Notice the huge dispersion in how much the price of these funds has fallen over the last month. This is from February to March in 2023. The closer you are to the epicenter of the problems, which is in the US, in the regional banking sector, the larger the sell-off. So KBW Regional Banking ETF, which is just those US regional banks, that's got a fall of almost 30%. But notice that some ETFs give you exposure to some of those regional banks more than others. So this iShares S&P US Banks ETF, ticker BNKS, has got a much bigger fall than, say, the SPDR S&P US Financials Select Sector ETF, ticker GXLF. And as we move further away from the United States, say to Europe, then the sell-offs get even smaller. And for the broad US market, with SPY, which tracks the S&P 500, currently that's only down about 3%. So the take home here is that you have to be really careful not just about the geographic exposure, but also how much small cap and mid cap exposure you get in the United States, because that'll hugely affect your risk and of course your return. Now I've taken just 4 of those ETFs and I've looked at their return since the beginning of February. And you can see that the US S&P 500 has pretty much shrugged off the problem now. It's only down by around 3%. European financials too are only down about 6%, US financials 12%, whereas US regional banks are still floundering close to a 30% sell-off. But there has been a significant uptick recently as regulators have stepped in and done some shock and awe policies in order to address this problem. Given that we've had that sell-off, where does that put us now in terms of valuations? So if we look at the forward price to earnings ratio for each US sector, so here we've got the price of the index divided by the forecast earnings over the coming year, such that a high multiple means that the sector is expensive. Another thing you have to consider is that some sectors are typically expensive, more expensive than others according to this measure. So real estate is usually expensive. But certainly if we look at financials right now, they are looking considerably cheaper than they were. They're at an 11.2 times forward earnings multiple. Only energy is cheaper at 9.1 times. So there's no question that this sell-off in US financials has made what was a not very attractive sector or sexy sector even less attractive. But from the point of view of a long-term investor, of course, we see the opposite. We see a sector that's depressed and which has a huge amount of government, but also regulator support, and that itself is creating greater return over the long term. So whereas some people see a crisis, others will see an opportunity. Now, if you're a member of our community in PensionCraft, then we talk about valuation a lot. So we've created a set of tools that help investors track where we are right now in terms of valuation in the US. So this is what it looks like, and it's an interactive tool. Here we're looking at the S&P 500 valuation, and you can see it's roughly at the 10-year average right now. But you can also look at other measures such as the Shiller-Cape ratio or the Shiller excess Cape yield, which adjusts for the real rate of interest. So if you are interested in becoming a member and getting access to all the goodies that go with it, such as the trackers, but also Slack, so you can ask a question whenever you want, and a growing library of members-only content, then just go to our website, PensionCraft.com, and there'll also be a link to that in the description beneath me. Now, why would you consider buying financial exposure in the middle of a crisis? Well, one answer is about valuation. If you look at the valuation of information technology, say, and financials versus the broad S&P 500, and that's what you can see in these 2 graphs beside me, if the value is above 1, it means the sector's priced above the S&P 500 as a whole. And if it's less than 1, it means that it's priced at a discount to the S&P. Now notice how information technology, despite the huge sell-offs in 2022, is still relatively expensive. Whereas if you look at financials, they've been out of favor since 2010. And with this little dip downwards, you can see that they've actually got quite a bit cheaper. So the price to earnings multiple for financials is 65% of the S&P 500 as a whole, whereas information technology is at a 30% premium. So if you are a value investor, you can still apply that at the sectoral level and say, well, this is a good opportunity. I think financials will do okay from here, and I think they're too depressed given the amount of support which they've got right now. And make no mistake, that support is huge. We've had this incredibly important press release from the Federal Reserve, which describes how US banks, including regional banks, can get a loan of up to 1 year in length. And it's not just banks that get access to that, it's also savings associations and credit unions. But to get their hands on that money, all they have to do is present treasuries, agency debt, or mortgage-backed securities as collateral to the Fed, and in return, they get cash. But what's truly remarkable is that if they present, say, a 30-year bond, which is valued at 70 cents on the dollar, the Federal Reserve will pretend it's worth $1. In turn, that also means that these banks don't have to have a fire sale of their treasuries, which are currently making a loss as interest rates have risen a lot. Remember, that's one of the problems that Silicon Valley Bank faced. As deposits left the bank, they had to sell some of their assets, their treasuries, and they realized a loss. Well, this new loan program from the Fed means that banks don't have to do that anymore. They have access to this massive pool of liquidity, assuming that they do have those high quality assets. So no more fire sales, and that provides a big support for US regional banks. And we've also had Treasury Secretary Janet Yellen come out and say that the US government is prepared to give even more support for regional banks. The point is that these regional banks provide a lot of credit for small businesses in the United States. So they are absolutely key to the US economy and to US growth. So this is why we've seen a stabilization, as these policy responses have been pretty impressive. And even one of the most hard-hit banks, which is First Republic, you can see their share price beneath me, that seems to have stabilized. It's still down 86%, but these policy responses do seem to have worked. The sell-off seems to have stopped, and some of these stocks have turned around. So if you are going to be contrarian and buy financials right now, what are the risks? Well, critically, financials are cyclicals. If there is a recession in the United States, as many people expect, then banking stocks would suffer. Also, a big consequence of this recent crisis is that the cost of capital for banks has increased, and that reduces their margins, also their profit growth, and of course, their share price growth. So it's not all looking great for US financials by any means. And you've probably heard the phrase, don't catch a falling knife. While US regulators have had lots of shock and awe, other regulators elsewhere haven't. So it's still possible that we could get fallout in Asia, say, or more crises in Europe. So escalation of this crisis is still possible, either directly in other regions or indirectly as a follow-on crisis from the banking crisis, as other companies are starved of capital and potentially loans could go bad. And we could still get many banks going into default. So here's the price of UBS and Credit Suisse, and this shows their returns since the beginning of 2022, along with a whole bunch of other banks. Why did Credit Suisse fail? Well, it wasn't because it was poorly capitalized. It was simply because it had a series of crises and lots of scandals. People just weren't willing to put their faith into Credit Suisse any longer, and there's nothing a regulator can really do to address that lack of faith. If a bank suffers huge deposit outflows or people just refuse to do business with it, then it will go down. So what we're likely to see in this sector is a lot of consolidation. The weakest banks will probably not make it, to the benefit of the largest banks. So one strategy might be to go for those banks, the ones which have the strongest balance sheets, the greatest reputation. Maybe they'd be globally systemically important banks. Of course, the returns will be lower, but you'd be less worried about losing your investment. And that's if you do go down the single stock route. What funds are available to give you this exposure? Well, if you're based in Europe, a great place to look is Just ETF. Here are 5 of the cheapest ETFs which give you exposure to the financial sector. Notice that all 5 of these give you exposure to US financials. Now, as we said, it's really important to dig into these. You can do that on Just ETF or elsewhere to see what the holdings are. How much of it is large caps? how much of it is mid and small caps, because that'll affect your risk and return. If you're based in the US, an equivalent is VettaFi or ETFDB, which gave you these 5 largest funds. Notice that one of them is a 3 times daily return fund. You probably don't want leverage in this kind of environment. I'd probably keep away from that. But you're spoilt for choice in terms of financial exposure. Now, all of these are just for regional banks, and there are even more ETFs if you just want financials exposure. Now, if you do want to go down the single stock route, here I've got the largest holdings of that KRE US Regional Bank ETF. So maybe you'd want to tilt towards larger banks within that regional banking sector in order to have a little bit more safety and also stronger balance sheets. So the trade-off here would be, what does the balance sheet look like? What does the business look like relative to the size of the sell-off? Maybe some of these large sell-offs here are not justified, but clearly you have to do a lot of research to try and figure that out for yourself. And if instead of sorting by the size of the holding within KRE, we look at the biggest sell-offs, you can see that First Republic Bank is at the bottom of the list. So if you're really contrarian, you'd be fishing amongst these names. But remember that if you do go down the single stock route, there's a potential 100% loss, so be very, very careful. Personally, I'd stick to using funds because they're automatically diversified. So in my fund portfolio, I have made a tactical purchase of US banking exposure. And if you're a member of our community, I can tell you which fund I bought and why. I often discuss the nitty-gritty of my fund portfolio within the community. So if you do want to learn more about joining us, then don't forget there'll be a link in the description. Just go to PensionCraft.com and there you can learn more about our membership. So as always, thank you for listening.